the stock is up 40%. In the last 5 days alone, the stock is up nearly 10%. One of the biggest headwinds lifting with crude oil prices coming down. That and more is what we're going to be discussing with the top management of JK Tyres, the Chairman and Managing Director, Raghupati Singhania, here with us. Good morning. You know, if you look at the stock prices of yours and your competitors and industry peers, tyre stocks are doing extremely well. Crude oil prices have now come down. It was perhaps one of the biggest headwinds for tyre companies. What is this going to mean for pricing, for margins? Are things going to look even better in Q3 and Q4?
Crude prices have come down recently, or just coming down 2 days back. And we must appreciate that any impact on the raw material prices, that means the derivatives of the crude, has a lag effect of at least 2 quarters, anything between 5 to 6 months' time. So whatever we are seeing today, what happened 2 days back, we will see the lag effect coming on for in next 5 to 6 months' time. So depending on that, we will see how strong are the tailwinds that will determine our future. Having said that, nonetheless, we are seeing, if not softening somewhere, but at least stabilizing of the input prices, which are mostly petrol-based, as you know. And that should help us in improving our margins, as you said. The question is that these margin improvements are difficult to predict today, that what percentages EBITDA margin would they reflect in. But all I can tell you is the last 2 quarters, for instance, we have been improving or have been able to improve our EBITDA margins definitely on X basis points. And going forward in the next 2-3 quarters as well, we foresee that our EBITDA margins must be improved couple of basis points every quarter on quarter. So that is the hope that we are working on with. Of course, the bigger impact of the tailwind can be felt only after we see the impact of the reduction or the consequential reduction of these oil prices.
Right. Mr. Singhania, because of the competitive intensity in the industry, companies couldn't pass on the raw material cost inflation fully to consumers, as we understand. Going forward, though, should we expect more price hikes with inflation at elevated levels still?
We have been working at it to constantly review and revise our prices to improve our margins. And incidentally, in every quarter in the last 2 or 3 or 4 quarters really, we have been revising our prices gradually but definitely. And we also plan to do it in the next couple of quarters, because we still have a yawning gap between the increases in cost versus what we could manage to increase the prices. But then again, please let us not forget that we are working in market forces. So depending on how much the market will allow us, we will.
Right. Mr. Singhania, your capacity utilization was at 85 to 90% in the second quarter. Share with us the plans that you have for capacity addition in the calendar year ahead.
I think it's a very important question you have raised, because as you are aware, in 2018 we had announced a CAPEX major program of nearly 700 crores, but we had to call it a halt because of the ongoing then on-swing pandemic which happened immediately. But now we are reviving those CAPEXs, and we have already executed nearly 200 odd crores of CAPEX in the last quarter, and the output or outcome of that is already available to be sold in the marketplaces in the PCR space. And going forward, our board has approved further CAPEX of nearly 800 crores, which includes both expansion in the PCR line as well as to an extent in the truck radial lines. And that should hold us in good stead, and we should be able to, in fact, in the truck line, if I may, the demand, as you know, was a little subdued. Now it is catching up in the going forward in the couple of quarters. So in a way, our outcome from the CAPEXs will also very much match the timing. So in a way, I think it was a wise decision to match that. And likewise, in the passenger car, we are, as I said, we are undertaking a CAPEX which will fructify by middle of 2023. And yet more, we have further lined up capexes for the year 2024, which we will of course have to first internally seek approval from our board, and then I will be able to share with you.
All right. Wanted to get in a view then from you, Mr. Singhania, what the capex plans are right now, how you're planning to fund those, because your current debt levels have been a bit of a concern for investors.
No, in fact, you have put it mildly, but leverage has been a deep concern for us, and we have been working at it from last couple of years to reduce our leverage, improve our leverage. And in fact, if I may share, in the last 3 years, we've been able to reduce our long-term debts by nearly 30%. And in next 3 years, we will be able to reduce them by another 30%. So in fact, that is one of the agendas, and that we are very much sticking to the timelines that we have planned. As far as the capex is concerned, yes, we will have to fund it from both. We will have to find more equity to fund some of it and also borrow some. And we are planning to fund them in a softer equity debt ratio than what we have been hitherto doing. And then temporarily some debt may go up, but then it will be commensurate with the outputs also going up sharply. So therefore, may I put it this way, that they will be far more manageable than we could think of.
Now, your margins for the Mexico operations keep fluctuating. When do you...
I think in this quarter as well, we are seeing double-digit margins out of Mexico. And going forward, I think we should be performing in double-digit markets on a sustained basis. There were earlier double-digit margins, but which became upset because of so many factors, not only cost increases, but also the pandemic, the lockdowns were longer there, and so on and so forth. But that's a bit more of a history. But going forward, I think we'll be able to maintain our margins. And incidentally, there again, we are willy-nilly utilizing 95% capacity of our passenger line business. So I think we will be able to do reasonably well in that market.
Ms. Singhania, before we let you go, we have to talk about EVs, which is taking up so much of the mind space. Tell us, what's the contribution from EVs towards the business at the moment? How is this going to scale up? Let's take a 3 to 5 year horizon.
You see, percentage terms is insignificant, barely in single digits percentage-wise, and that is understandably so. But going forward, and presently, let me share with you, we are working on all the 3 verticals of EV. First is the commercial vehicles. For instance, in Delhi, a complete fleet of buses is flying on our EVs, which a company had introduced. And likewise, we are developing EVs for whole range of buses in particular, and also for the trucks subsequently. In the car range, we are already supplying to a couple of customers our EV tires, which are going regularly. In the two-wheelers, we are supplying to nearly 6 and odd manufacturers in EVs. So we are working on EVs to develop more varieties, more type of tires, working with more OEMs. And each OEM have a different requirement in terms of their rolling resistance, their torque improvement, and so on, and weight. So in fact, we are working very dedicatedly with the EVs to develop more tire. And to put the point across, I think we are seeing great future in the EV, and we have allocated lot of resource, including our R&D resource for development of EVs, working very closely with the OEMs.
Okay, Singhania, thanks so much. So that's JK Tyres' strategy and how it's going to be approaching the hot EV space and the plans and how it's working.